in order for you to have one as a physician, you're going to have to include some of your staff members. The more they make, the more money you're going to have to put in the plan, which comes across as a cost to you. And the more the plan costs, the less the tax benefits are valuable to you, right?
Welcome to the Physician Family Financial Advisors podcast, where physician moms and dads like you can turn today's worries about taxes and investing into all the money you need for retirement and college.
Hello, physician moms and dads. I am Nate Reineke, certified financial planner and primary advisor here at Physician Family Financial Advisors.
And I'm Ben Utley, also certified financial planner and the service team leader here at Physician Family. Nate, I got a little surprise for you this morning.
Okay.
So last week when we recorded, you said the word plan over and over again. And I said, you know what? We ought to have a drinking game. So today we have a drinking game. I've got my Physician Family mug here full of BNF kombucha. It's ginger turmeric, just in case you want to know. And every time you say the word planner, or planning, I'll be drinking. And since you said certified financial planner once, I'm just going to get started right now.
Okay, what's BNF?
BNF stands for Billion New Friends, because kombucha is a fermented beverage that is supposed to be good for your gut, but has a little caffeine, little zing, and I love ginger. So
nice.
Off we go.
Yes. Okay, awesome. So wait, if I say plan.
Yep.
Oh, there it is.
Sorry.
Okay.
Got
I was
drink.
testing you.
Bottoms up, baby.
All right. Well, we got more questions today. There's some good ones in here. I'll start with the first one. So we got OB-GYN in Virginia. So they said they have $700,000 in their bank account, and they want advice on how to invest it. I'm going to start here with a high level. Based on the question, I mean, it sounds like they're ready to invest it, but I got a call from a prospective client yesterday, and they sort of had a similar question. I don't think it was $700,000, which is a huge chunk of money to be sitting around in your bank account, but it was interesting because when they asked me this question, I could feel some nerves about, like, what would you do with it? What would you do with their extra cash? And got to the bottom of the nerves. I think they sort of were under the impression that I would say, as the investment guy, give me all your money, I'm going to invest it right away. Like, and I don't, that's just not, I mean, it never works that way here, and it shouldn't.
First off, I have to get a chuckle out of give me your money.
Right.
And what are you going to do with it? Like
it's not theirs.
Like it's not theirs. Like, we're financial advisors, not thieves.
Right, exactly.
Or custodians or babysitters. Yeah, it's your money.
Yeah, and that's the way it should be treated, and it's your life.
Yeah.
So I think when they, a lot of times, people who've been with us for years, they know this, and they get more and more comfortable with, like, hey, I have $50,000. Should I invest it? Or go through the process.
What should I do with it?
Yeah,
really?
That's really the question. And so I thought it would be good. We've talked about this before, but it's important. So, when you're looking at a big chunk of cash, I think there's some nerves around, should I invest all of it, or what exactly should I do? And as you and I say, cash makes you stupid. So we should probably limit it to what you actually need. So the question is, what do I need? Well, you need living expenses. You and I have labeled that as about 2 months. 2 months worth of living expenses.
Yeah, you're talking about just like liquidity in your bank
account. Some liquidity.
For check, that kind of thing.
Emergency fund. I won't go deep into it, but it is usually 3 to 6 months, depending.
Yeah.
But, look at your disability insurance. If you owe big taxes, maybe you need to account for that. Are both of you working? Both spouses working can lower the amount of emergency fund you may need.
And I would say if you're like a partner or a stakeholder in a healthcare organization, you might get a capital call, especially if you own a medical office building or surgery center, that kind of thing. So I would veer toward the 6 months ends of things, just in case.
Agreed. Yeah. Another big one is just short-term goals. Do you have some home improvements you want to do and just feel like you're supposed to invest it? Well, that's why you have a plan. Go ahead, Ben.
Yeah. No, I didn't have anything to say. I was
No,
just
go
listening.
ahead. I said plan.
Oh, sorry. Bottoms up.
Yeah. So, have a plan, and then,
Bottoms up.
and if you can spend that money, it's okay to spend it. You know, if you're on track, then you can do home improvements. You can go on a vacation. But after that, you're looking at your goals. So, retirement, college, and sometimes that includes debt reduction. It's not always just invest it right in the market. But let's hear, I don't know, your thoughts on this about how to actually invest it if you were going a different direction.
I agree with everything that you said, but you know, we're planners. I'm not going to drink to my own PLAN word, but you know, I always start with a goal. Like, what do you want out of your life? What outcomes do you want? You know, what kind of education do you want your children to have? What legacy do you want to leave? You know, what kind of retirement do you want to have? When do you want to have it? What are you going to spend? I always begin with a goal, and that always gets into planning, which ultimately tells you just how much you have to save so that the money that's left over you can spend, right? So I would say that if they're on track for retirement and they're on track for college and they're on track for all the other goals that are in their plan, then there's a lot of flexibility. I've seen clients who have set aside money for vacation funds and cars and home improvements, and they're on track for retirement and they're on track for college. And many times we'll say, hey, you got this mortgage debt, whether it's at 7% or 2.5%, and you need to pay it off before you retire. You've got, this extra money. One thing you could do with it would be to exterminate the debt. People have different feelings about that. Some people are like, I've got 2.5% interest. I don't want to pay that off. Other people are like, I want to be done. I want to be finished with my mortgage. I want to own my house outright. And so that's when we get the ability to do some really big things. But that's not what you do unless you have, sewed up college and your retirement is really, really on track.
Right.
Yeah.
Okay. Psychiatrist in Illinois. By the way, Ben, we love psychiatrists. Why do you think that is?
Because we're mental.
Maybe. They just are lovely to work with.
Yeah.
Okay, my practice partners and I have agreed to establish a cash balance plan. What guidance do you have to offer for us navigating establishing the plan? Any pitfalls to avoid? Okay, let me set the stage. You're a lot better at the technical side of this, so let me get the high level, okay? So here's where they're at. They've already agreed to take on the extra complexity of a cash balance plan because that's there. But you might say how to do this. We're not saying you necessarily should because, there's funding commitments, there's administrative costs, nevertheless, these partners have agreed they want to save some taxes, right? So, talk about the team involved. I mean, they're going to need a financial team to do this. Like, what does that look like?
Yeah, this is not a DIY kind of thing. No. So, first thing you need is a person to draft the document that creates the plan, and that is usually an ERISA attorney. You would need another party called a third-party administrator or a pension actuary. We refer to them as TPAs. A TPA is a person who works actuarial assumptions, which is to say they help you calculate how much you can contribute to the plan, because it's not like a 401k or profit-sharing plan where the amount you can put in is defined. The amount that you're promising to have available at retirement for each of your people is the promise. And in order to promise, you have to do some time value of money calculations that are based on people's ages. And let me just say that it gets very complicated very quickly. And there are just a handful of firms in the country that really specialize in this. And a lot of them actually outsource or are the outsourced partners for a number of record keepers throughout the country. So it's the deep end of the deep end of the pool. All that is to say, though, you need these people. They're not terribly expensive given the amount of money at stake here.
Right.
So, but you can't have a plan without them.
Yeah.
Third person you need is somebody to manage the money, whether that is a financial advisor or a managing partner in your firm. somebody has to make investment decisions inside that program and act as the fiduciary. So those are your three parties, except for the participants, right? So you have to have participants. And typically you have to have about half of your eligible people participating. So did I answer your question? Because I've got more.
Oh, go ahead. No, I want to hear it.
So in terms of pitfalls, these are not for every doctor. So here's an example of a group that would not be a fit for this. It is 2 or 3 physicians that are relatively young that have a large staff, maybe 10, 20 different people in their staff that get lower compensation, lower salary. That's kind of suboptimal. So especially if your staff is relatively older, okay? So an ideal circumstance for this is, I see this all the time with the radiologists. It's 3 radiologists, mid to late 50s, maybe 1 or 2 staff that are working with them or under them. And, like I say, the staff is younger, the physicians and providers are older, and there's a big difference in their compensation. So the physicians are earning, mid 6 figures, and the staff is earning maybe very low 6 figures or high 5 figures. So the difference in the compensation, the difference in the age, and the ratio of physician owners to staff, those are the 3 critical figures. And it could really go either way, but that's the major determinant about whether or not the physicians are going to really benefit in terms of taxes from this program.
Right. So you've said something a couple times. I want to make it clear to the audience, I guess, why. Why is it important to consider how much your staff makes?
Yeah, because in order for you to have one as a physician, you're going to have to include some of your staff members. The more they make, the more money you're going to have to put in the plan, which comes across as a cost to you. And the more the plan costs, the less the tax benefits are valuable to you, right? There's a cost benefit. And at some point, the cost of compensating non-highly compensated people outweighs the benefit of the tax break. And this really is a tax break thing.
Right. And the last thing I would add, kind of the feeling I get, no one's ever actually said this, but the feeling I get is that the physicians will make the decision to do it, and then they sort of want to hand it off. But your involvement in this really doesn't end at just the decision to do it, right? You have to, there's contribution levels that you have to make decisions about, vesting schedules for your staff. Also, whether or not it's a standalone plan. You might also have a 401k.
Yeah, there's integrations to be considered. So, you and I are talking about the very deep end of the pool because this is a partner who's setting up a plan, right? A more clear-cut case is where, we're working with a client that is a participant in a defined benefit plan and they're not a decision maker. They work for an outfit like, for example, I work with a cancer doc and they're part of US Oncology, and their subunit has a defined benefit pension plan, aka cash balance plan. And in those circumstances, you don't have control over the investments as a participant. They're going to be invested as they're going to be invested. And typically, these are very, very conservative investments. They typically have a target rate of return that's just a little bit above inflation. And I can't go into that because it's really complicated. But suffice it to say that when these are run correctly, they're run very conservatively. Now, you can consider that the conservative portion of your portfolio. But what we find is that with very young physicians, the math does not work out on defined benefit plans. Because yes, there is a tax break to be had, but that tax break is spread over maybe a lifetime of 30 years. At the same time, they're getting a low rate of return. So where we see this work out really well is for physicians that are nearing retirement, 15 years from retirement, 5 years from retirement, particularly. And there's even benefit to be had within 5 years until retirement. But with such a long time to recoup that tax benefit, young physicians lose out because the rate of return is low inside these plans.
Right. So, compound interest, it's a fun thing to think about, fun thing to say, but this is where it really comes into play. It is so powerful that no matter how much taxes you save, if you're 30 years old or 33, it's just going to obliterate the taxes.
Yeah.
Right.
Exactly. Before we go on, could you say the word PLAN for me, please?
Plan. You're thirsty?
God, I was so parched.
All right.
Bottoms up.
Okay, speaking of radiologists, we have a diagnostic radiologist from Florida.
Go Florida.
Yeah. Variable universal life policy. So they have one through a well-known insurer who has a bad reputation in the physician world and who sold him VUL, and now he knows better. Okay. Wondering what to do with it. So, these policies, they kind of are sold, much like many things that are sold, in a really unfair way. But I don't know if it's necessary because now they know better. But I get why people buy this stuff when they're being sold. They're sitting across from a salesperson, and that salesperson's saying asset protection and tax deferral and tax-free withdrawals. The things they don't say, and this newly well-read physician didn't hear high premiums, tax-deferred growth rather than it's the tax-deferred growth is ordinary income and not capital gains. So they don't tell you those things, and
they didn't hear modified endowment contract for borrowing.
They're not hearing that stuff.
They didn't hear.
Maybe it's in
they
the
didn't hear
fine
any of
print,
that stuff. They didn't hear high operating expenses, mortality and expense charges. They didn't hear the word insurance company. Sorry, can we say that on a family network?
Yeah.
They didn't hear all that stuff. Yeah. So these are bad news. And if you get stuck with one of these things, you got options, and there's a pathway to go down to determine like what to do with this. Do you think we ought to talk about that?
Let's do it's we've done a whole 40-minute episode about this, so there's a lot here, but let's talk about it. I got 3 steps, and I'll let you talk about them. But so first is to make sure you have enough insurance before you just get rid of it,
because some people legit need life insurance.
Most people, right?
Yeah.
I talked to a 50-year-old physician the other day, and they left a job that had a bunch of insurance, and it was appropriate for them to have life insurance because they had a big mortgage, and one person sort of retired, and they need to make sure that's covered. So you need to get enough coverage before you kick the old one to the curb. And I see it all the time. People, once they find out I'm in this evil VUL, which isn't actually evil, but
expensive.
Yeah, expensive.
Let's just say expensive. Yeah.
They want to get out right away, but just slow down a bit and get covered before you kick it out the door. Next one is the next step is to get rid of it without paying a bunch of taxes. Can you talk about that part?
Yeah. So when you put money in these things, you establish bases. It's a little bit like buying a stock where you have what you paid for it, and then you have what it's worth later. Okay. So every premium that you pay accrues toward the basis. So let's say this person put in, God help them, $50,000 in premiums. Okay. If the cash surrender value of this product is now $40,000, there's a non-deductible loss, and there's no tax consequences. If the value of this thing is now $50,000, there's no loss, it's break even, and no tax consequences. But if this thing is now worth $60,000, their cash surrender value is $60,000, and their basis is $50,000, then they have a gain in the policy of $10,000. And so if this thing gets cashed out today, then that policy would have an ordinary income of $10,000 payable, which for physicians like we serve is going to cost them somewhere between 25 and 40%, depending on whether we're including state and federal income taxes. So that's the first thing to know is understand your tax status. Okay. So next thing you do is figure out what do I do with it? Is that part of your step 3, Nate, or should I just keep talking?
No, go ahead. What should I do with it?
So I guess what was your step 3?
It was like managing your gains, which is exactly where you're going.
Yeah. Okay. Managing your gains. So there's a couple ways to go. If you have a loss, you probably just cash it out, right? That's the smartest thing to do. Get the insurance monkey off your back. If you have a gain and it's a small gain, you're just going to have to gnaw your arm off to get out of this thing. And we see people do that. We see people pay the taxes just to be shed of the insurance company. But if you have kind of a big gain in this thing, let's say you put in 50,000 and you have it's worth $80,000 now. You have a $30,000 gain. It might be okay to pay taxes on that, but you probably don't want to pay it while you're in your top marginal tax bracket. I mean, maybe you ease out of that in retirement. That's one way to go when your taxes are lower. The other way to go would be to what's known as a 1035 exchange. And that's where you trade in the value of your life insurance policy for an annuity policy. It could be a fixed annuity. It could be a variable annuity. And there are some very low-cost providers. Vanguard used to offer these. Fidelity has low-cost annuities. We know a provider that has a range of low-cost annuities where you're not paying a fortune to get out of these things. And let me break it down in terms of fortune. So I've had clients ask about whether or not their S&P 500 fund is charging 0.05% or 0.03%. All right, so we're talking about $20 on $10,000. Okay, with these things, your all-in cost could be 3.00%. It could be 100 times what you'd pay for an ordinary tax-efficient mutual fund. Right? So I've had clients who've come to me and they said, I've had this thing for 20 years. I look back at my returns, and even though it's been invested in stocks, it looks like I've only earned like 2 or 3%. And that's because they've been paying mortality and expense charges, high operating expense ratios, the whole 9 yards. It's just been a boondoggle for them.
Yeah. Yeah, it's unfortunate, but at the end of the day too, just I feel the need to give encouragement anytime we talk about this. It is $50,000, and that's not going to make or break your plan. It's not a big deal, but just do the best you can with the new knowledge you have.
Yeah. And when people come to me about this and they say, gosh, I met this guy, when I was in training, and I bought my DI from them, and then I bought this thing from them, and then I kept buying it over the years, I'll say, okay, well, here's what we have to do. And they're like, but I really like this guy. They're really nice. So the thing you have to know, to all listeners, all physicians, and all consumers everywhere, is that all of the mean financial advisors, the rude financial advisors, got fired long ago. So there are only nice financial advisors, right? So if your financial advisor is nice, they can still be unethical, they can still be greedy, and you really have to watch yourself.
All right. Next question. General surgeon in Nevada, married with 2 adult children, $7 million in assets. Okay, that's for retirement. Plans to work 10 more years and save a whopping $30,000 a month.
That's some real money.
Thinking of long-term care insurance or whether or not to self-insure. What should I do? Okay, I've been setting the stage, so I'm going to keep going. Long-term care insurance is meant to cover, because people wonder, like, do I need this? Right? They read about it somewhere. Some people do. Yeah. But it's meant to cover expenses in your older years that essentially isn't covered by regular insurance. So this is like daily living activities, and you're older and you need someone to bathe you. Stuff like that. I'm sure we're on the same page about this, but I did some math actually. Before we started recording.
Wait a minute. You did some math, actually?
Well, actually, no. I plugged it into a calculator.
I'm stunned. You did some math.
Yeah. $7 million now, invested, relatively. I chose, I think, 6%. 6% return.
Yeah.
Okay. Plus $30,000 a month. That's going to be edging on $17 million.
Whoa.
Yeah.
I was just thinking about the principle. I mean, $30,000 a month times 12 months, that's 360 times 10 years is 3.6 million on top of 7.
Yeah.
I mean, that no compounding, no return, that'd still be darn near 11 mil.
Right.
And most of that's after tax, right? So, with $11 million, people would be, I think they would be surprised to find out how little long-term care costs, even in the most expensive states, relative to, I mean, gosh, I would think maybe $500,000 to cover it.
Yeah. And I think a lot of people, when they think about costs, it's hard in your younger years to even imagine what life is going to be like in your older years. And I have had grandparents and grandparent in-laws go into these, facilities, and they're affording this, and they don't have $10 million. But the reason that I think the surprising thing to me was how little they spend outside of getting this help. If you get to the point where you need someone to dress you, you're not buying new Mercedes every 5 years, right? Like,
you're probably not even buying used.
You're
Toyotas.
You're not even driving, So this is for it. Really, long-term care insurance is mainly for the middle class. Like, maybe they have some money, but like they don't have enough money to pay $10,000 a month to a really nice facility, which a lot of them don't even cost that much.
Yes.
But if you're, if you're lower class with you don't really have much saved at all.
Well, there are people for which Medicaid covers.
Exactly.
This.
They're covered by Medicaid.
Now, admittedly, there aren't a lot of Medicaid beds.
True.
But you typically have three strata. You have those who can't afford it and shouldn't have long-term care insurance, and there's Medicaid for them, even though it's not great. You have people who can afford it and probably should self-insure. That's your top third. And the middle third are folks who can afford premiums, but they probably couldn't afford the hit.
Right.
And those are the folks where long-term care is indicated.
Yeah. So, and this is pretty cut and dry, right? They should not get long-term care insurance.
Not with this.
Not
with
this
this.
case.
And most of the physicians we see probably, they shouldn't have it. A couple reasons. So, if you are the last one to need long-term care, then you'll have a home. Likely it's paid off. And so, since you're not going to be living in your home, you're living in the home. You have the assets that are available in that house to use from long-term care. Another thing is, it's not like long-term care is a special expense. I mean, you go from, paying your property taxes, paying for food at home, paying for a lot of things that you have as your ordinary cost of living. And now that you go into a home, all those things are part and parcel of paying the home.
Exactly.
Right. So that's all included. So, I think most physicians have this covered, but I can say that I personally have had experience with 3 different family members that went through this. One had Medicaid and was in the home for 10 years before she died. Another one, another was a couple. They were both insured, and they used literally every dollar of their long-term care insurance, and then another maybe 6 months worth of living expenses and passed. And I handled their books at that time. This is long ago. Family members handled their books. I helped them get the policies. I managed their accounts during that time and their tax situation. And you're correct. There's really not a lot to be paid for outside of long-term care.
Yeah.
And these are folks that were kind of in the middle class. So, I think that for most of our clients, again, it's long-term care is not really a match for them, with one exception. So, one of the physicians we serve is married to a woman where dementia runs in her family, early senescence. And most of the people in her family suffered from dementia. And despite the amount of money they had, we said, yeah, go ahead and get it, right? And they were young, and so it was relatively inexpensive. So it's just a nice backstop that will kind of preserve their stay.
Yeah. Okay. Yeah, that's good.
Yeah.
You summed it up nicely. But, essentially what I'm just trying to say is that your expenses shift, but this is plenty of money in this case to pay your own bill. All right, last question here. We have a primary care physician in Texas. My dad passed away recently at age 74. I'm inheriting half of his traditional IRA. How do I minimize taxes when I take it out? I'm going to let you run with this one, Ben. There's some solidified rules in tax code. I believe you're up to speed on those.
Well, living in Texas is a nice first step.
Oh, yeah?
Right? Yeah, no income tax.
Yeah, no state income tax.
Yeah, right. If you live in Oregon, it's going to be 10%.
Yes.
I'm sorry if you live in California, New York, it's going to be a ton. Yeah, so there's not really a whole lot of way to sidestep the taxes on this. I mean, the government wants to make sure that they get their money back from tax referral. And so you're going to pay taxes on it. There's no two ways about it. You can't take the money out and roll it into something else and get a tax break. It's got to come out. And the rules, there's devils in the details about the rules. I don't really want to go into the depth of it. But suffice it to say that that money all has to come out in a matter of 10 years. And in terms of the timing, if you're going to be employed as a physician and you're going to be earning what you're earning, let's say you're earning $300,000 a year, and you're pretty much going to be earning that for the next decade, then the thing to do is to spread these payments out equally so that you don't get pushed up in high tax brackets. Right. But let's say that you're 5 years from retirement, and then you're going to have 5 more years in retirement. You might take out as little as possible now, and then take out more when you're in retirement, when you're going to be in a lower tax bracket. The thing that you don't want to do is wait until the 10th year and take it all out in one shot, because in most cases, that's going to push you up in the tax brackets. And so you'll pay more than if you had paid a little bit over time. Yeah. So bunching these expenses is not a good idea because, like I say, it jacks up your brackets.
Exactly. Okay.
Yeah. This is a complex calculation that, thank goodness we have Chelsea on staff. She's our retirement planning specialist, and she has some software that she can kind of twist around this topic that makes it obvious kind of how to go and can run multiple scenarios. But again, this is the deep end of the pool, and I don't think this is the kind of planning that an individual should be doing on their own. It's tax complicated, and miscalculation here could easily cost you $10,000 extra bucks in taxes. I mean, easily.
Right.
So it's the thing where you need to get help.
Okay. And I assume, just judging by the fact that this question was even asked, that's a large IRA. If it was a small one, they probably wouldn't be too worried about it. So be careful. Could be more than 10 grand.
Yeah. I know we're getting more and more of these inherited IRA questions because our clients are aging and, just the general graying of America. There's more inherited IRAs. So,
okay.
Are you ready for me to take us out?
I am.
Okay. We are Physician Family Financial Advisors. We are here and ready to serve. The thing that makes us cool is we charge a level monthly fee that does not depend on the amount of money that you invest. So whether you invest $100,000, $1 million, $5 million, $10 million, it doesn't make any difference. It's the same monthly fee. So, we don't have a dog in the fight when it comes time to roll stuff over, or whether or not you should pay off your house, or how you should invest your $700,000. So that's one of the great things about us. The other great things about us is Kyle, Nate, Chelsea, and Jackie.
Yeah.
So if you'd like to join us, visit physicianfamily.com and click the Get Started button. You get a chance to chat with me, and we'll talk about what's really important to you about money. If you're not ready to take that step, maybe send us a question. You can submit your question to podcast@physicianfamily.com or call our answer line at 503-308-8733. Until next time, remember, you're not just making a living, you're making a plan, bottoms up, to make a life.
Nice.
Thank you for listening to the Physician Family Financial Advisors podcast. Are you getting all the tax breaks you really deserve? To find out, get your copy of the Overtaxed Doctor's Retirement Investing Checklist, available at physicianfamily.com/go. This show is for educational purposes only and is not personalized advice. Consult your tax advisor before taking action. All investments involve risk of loss. Past performance is no guarantee of future results. Read show notes for full disclosure.